So I want to dissect risk to reward ratios as well as risk management, and then really apply it to stock trading in particular. And the first concept I want to go over is the fact that in stock trading, the risk is not structured. And complete opposite in a structured game like blackjack or roulette, you have to put the money down before the game begins. You cannot lose any more than that amount or any less. In stock trading, you don't enter a position, for example, whether it's 50 grand, 10 grand, 5 grand, whatever you're trading with, and assume you're going to lose it all. And if you are, you're trading like a complete gambler. And maybe you can make some money in the short term, but in the long term, you're screwed. I promise you. So you got to structure your risk. And how you do that is risk management. But understanding the risk-reward ratios that you need. I mean, the break-even, how little percent of a break-even win rate you need if you have a good risk-reward ratio is what's going to give you an edge as a trader. So, for example, if you're always risking the same amount as what you're looking for on the upside, you got to be right 50% of the time. That's the most obvious one, right? But then you say, hey, I don't like those odds, so I'm going to say I'm looking for double on the upside as well I'm willing to risk on the downside. I only got to be right 33% of the time just to break even. And you say, hey, how about if I go 1 to 3? I'm going to risk 3 times the amount I'm willing to risk. You only got to be right 25% of the time. So this could apply to any percent basis. So you could say I'm risking 3%. I'm going to sell at 6% for 1 to 2, right? This is just a fraction. So you got to figure out which one is the most appropriate for you. And it's going to change. Every type of trading style is going to favor a different risk to reward ratios you're going to find. Whether you're scalping and you're just looking for a 1-to-1, 1 to 2, or you're doing more of a long-term reversal trade play on bottoms, or you're doing momentum and you're looking for 1 to 4s and stuff. So, but what you realize is the tighter and tighter you cut your risk, the easier and more realistic the 1 to 5, the 1 to 4s and 1 to 3s can be. And we're gonna go over that on the chart. And I'm gonna apply all this really realistically into trading itself, because this is all just a concept. Because say you're set in stone, you're going to sell every time at 1% and you're going to sell every time at 2%. You only got to be right 33% of the time. But realistically, there's going to be a time where you're going to take more than a 1% loss, just because you won't be able to get out on the bid, or you won't be able to get out where you wanted or planned to, because it's trading and you got to work with the price action it's giving you. It's not set in stone and it's not an exact science. So, but you got to wrap your head around this concept of you're looking for double, 3 or 4 times amount that you're risking on all their trades, and you only need to be right 33% to 20% of the time to break even. So you could be a profitable trader and only be right half the time. But that's only if you cut loss at that small amount. And the cool thing about trading is, we're going to go over it. You got to be set. You got to be strict about the risk. But on the reward side, you can be more dynamic if it goes beyond it. And once it gets to that to reward, possibly put your stop and protect any downside, and then try to continue to get upside. Say it keeps going, but we're going to go over that. And this over here, this is going to be a real good example of the power of losses. So not trading with your whole account, because I know a lot of people maybe put 10 grand in, 20 grand in, and they start trading with that 20 grand or that 10 grand, their whole account on the trade. Say you take a 50% loss, you get left with half that amount. You now need 100% loss gain on your next trade just to be break even. I always think that's a good example to show how powerful a loss is when it's that big. I mean, if you lose 70% of your capital, you now need to take that capital and make 233% gain just to break even. And it's also a good example of, say you're trading with a little amount of what you actually have. You take a 50% loss, you could just your next trade, you could trade with that same amount that you took the loss with and only need a 50% gain just to recoup your loss. But so you can't be trading with all the money you have when you can't control your losses. That's how you really lose as a beginner as a trader. So as a 5% loss, let's talk about losses, because this is all a ratio. So we got to talk about how applying this to the percent. You don't want to say I want a 5% loss, because then just for a 1 to 4 you need a 20% gainer to sell to have a 1 to 4. And we all know if you're an active day trader trying to scope out 20% intraday moves as opposed to 8% and 6%, it's just going to be a lot less frequent and harder. You're going to have to be chasing like the hot, crazy trading move that's just moving all crazy on the day. And you don't want to do that. That's the ones that are unpredictable like that, the ones that are holding and all that, and has all the crazy volume, the top pre-market gainers. So more importantly, you don't want to take more than a 2 or 3% loss on all your trades. I mean, I like taking a 1% loss when going as soon as it goes against me. 1%, 2%. As soon as I'm on 3%, I'm pretty frustrated. 4%, I'm mad. 5%, I hate myself. But realistically, some things are going to happen, whether it's news or just the price action or the level 2 or whatnot, or slippage. You're going to take occasional losses, and that's going to completely negate these percents a little bit. But those have to be rare situations. So let's talk about it on the actual chart. So I found one that's at $1. It's pretty much flat. So it's a real good example to do easy math off of. So say we got filled at $1 on the bid because it was holding. We loaded here at $1. It was holding. As I said earlier, 2% risk would put it at 98 cents. For the 1-to-1, you'd only need 102. So you're risking 98 cents. You're selling at 102. You only gotta be right half the time to break even. One to 4, you got the 1-to-2. So you got 33% there. You only gotta be right 33% of the time. If you buy a stock at $1 and you say, I'm gonna sell at 98 cents, but I'll sell at 104 first, if it hits that. You can sit there and hit that 40% of the time and long term get rich. So you gotta wrap this around your head. 106 would be 103. 1 to 3 risk reward. So you'd only have to be right 25% of the time, right? And then 1 to 4 would be 20% of the time. So if you buy a stock at $1 and you risk 98% and you were looking for 108, you could get rich if you just have a 30% win rate. 25-30% win rate, you're a profitable trader. 40-50%, you're going to be banking. But like I said, there's going to be occasional slip-ups. But on the upside, there's going to be also, if you learn that once you get good at this, say you get a situation where it goes right to that 108, it's looking strong. You put your stop loss, or you sit here and you watch the level 2 and you try to get some more, and you could get some more upside. And my point being is, you got to be married to that risk, but you don't have to necessarily be married to the reward level if it's looking good. That whole concept of letting your runners run. You gotta let this every once in a while. You get a play that's just good, and you gotta catch it, and that really pads your thing too, and it will take up for those occasional losses that will go against you beyond your risk level. So that's just trading a low dynamic on the reward side. but you got to be stuck on that risk level. And here's another perfect example I want to go over, because see how it was at, say you got here at $1. Had you not sold at 98 cents like you had originally planned, you'd be down 2%. You don't sell at 98 cents, it would go down here to 95, 99, 95, which at that point you probably would take your loss and just lower. And if you didn't, by the time it comes back up to $1 and you broke even, not only did you just stress yourself out, and risk had kept going lower, because at the time you did not know. You might have felt like, oh yeah, cool, it came back, but you didn't know that at the time. But more importantly, you wasted an opportunity. You could have sold at 98 cents, bought 95, 96-ish, and by the time it hit the 98 cents back where you should have sold, you would have had made your money back from that loss, and by the time it comes to $1, instead of you just wasting that time, you would have actually been in the profit. So this is a particular example on this stock, but I mean on every situation is like that. Every time until you realize that it's hard to cut losses, but once you realize that, it's not. And the big thing is the PDT. A lot of people are trading under PDT, so they don't want to take the loss and ruin their day trade or whatnot and the opportunity. But you gotta think, if you got in here at 1, and this is where the real traders get good. They obsess over their losses instead of their winners, because the winners will come. But if you obsess over the losses will just be small. They can keep coming. They don't really add up because they're small. And then the winners will come. So for example, you'd say, oh, I'm in $1, I'm only going to risk 99 cents. So at that point, for a 1 to 4, you'd only need $1.04. So if you got in $1 and you said, I'm going to sell no matter what at 99 cents, but I'm looking for 104, you only got to be right. Just to show you, because it's crazy. 20% of the time. So that's it when you get really stingy. So 1% is going to be pretty much the one tick on the thing. So you got in $1, you're risking 99, you want 104. That's when I was saying you can get realistically 105, 106, 108. That's a 1 to 8 risk ratio. You're trading 20% win with a 20% win rate, and you're profitable. I mean, it's pretty crazy to think about that. So it's about, you don't have to be right a lot, as long as you keep really strict about the risk. Just obsess about your not letting anything go against you to that point where you're down and you're hoping it's coming back, just getting out right away. And then when it keeps going down, you have an opportunity to buy lower than you ever even had in the first place. So, but let's be realistic. This example right here is going to be a good one, because at the $1 level, you know, everyone's buying that. So everyone's buying it at $1, and everyone's probably going to be having their stop losses and their risk around, you know, right underneath it, maybe 97, 98, 94, 95. So once it breaks under that $1 on the bid, so this is just a weird example, an after hour level 2, so it has no volume on some weird stock that has no volume in the first place. So, but it's a good example, because for example, if you got it at $1, this bid would be right here, would be at $1, and you had been waiting, got filled at the $1, and you'd be sitting here waiting here, and as soon as that $1 breaks, it would jump right here on the ask, like it is right here. And if your stop loss is at 98 cents, there's only 700 shares, for example, and then underneath it you would start getting filled in this. So in moments like this, when you're buying on support, as soon as that support gets broken, everyone's stop losses get triggered, and there's a lot of slippage. So realistically, you cannot control your loss. It's not set in stone. You can't say, oh, I'm going to get in $1 and set at 98 cents. And this is more important to the more you trade, the more size you have. You have to be more aware of what's on the bid, how much shares. And then you also got to remember, nothing on level 2 is for real either. For example, someone could put a huge amount of shares up here to give you think that there's support and a big buyer, and then flip it and sell at the same exact time. Spoof the bid and do the exact same thing with the ask. So nothing you see on there you could trust either. So you got to remember that every second of the trading day. Remember the risk reward, and remember not to let your losses go against you. And so this is I was using for an easy percent example to work off the dollar level, but it's also a good example of how hard it is when you're trading a penny stock. Say you had $10,000, you get into $1, and you sell at 99 cents, saying there's enough action going on and enough volume where you could get out with that on just that small one tick move. You lose $100, right? So which wouldn't be that hard of a situation. But the problem is, if it flashed out to 95 cents on your stop loss, you lose 500, right? And my whole point is that when you trade a stock that's higher, for example, like $4, $5, $6, $10, there's a lot more action to get out usually, especially if there's volume between that percentage. You don't have to worry about getting out in 1%, and this really applies to the low pennies when people are trading stocks that are 10 cents. I mean, 1 cent is 10%. You could get killed so fast when you're trading with size and lows. It's not worth it almost. So I mean, you eventually realize you can control your risk on the higher price stocks a lot easier and quicker. For example, like if I got into it's not that much, it's still a low price small cap stock, but at $3.35, and I'm doing a 1% loss, I get into $3.35. I could risk 3 cents. See what I'm saying? Usually on the level 2, there's going to be if there's a lot of volume, there's a lot more opportunity to get out in between. There's not just going to be some rapid thing. Not saying that there can't be, as we see these quick drops. But normally on the higher price stocks, it's a lot easier to manage your risk through the price action. With the profitable pig picks, you'll be getting access to the Discord and real-time SMS alerts that detail the particular ticker, a clear buying range, defined risk, and 2 price targets with a good risk to reward ratio, and a brief explanation of what type of play it is. On the Discord, I'll be going over real time, play by play, the situation as it changes. As we all know, trading is dynamic.